Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Joe Biden and Kevin McCarthy step up lobbying efforts in Congress to win approval of their debt ceiling agreement, while U.S. futures and treasuries mostly gain. A key gauge of Chinese stocks is hovering close to a bear market as pessimism builds. Beijing rebuffs a U.S. request for their nation's defense chiefs to meet. Plus, the Spanish Prime Minister Pedro Sanchez calls early elections after his Socialist Party suffers a crushing defeat in regional ballots. Well, May inflation figures slow more than expected. Now, first things first, so let's check in on the markets. Now, we did start the day on a high. Now, some of those gains actually petering out with the European stock 600. You can see pretty much flat at 461, flat 0.04% higher. So not huge, but the focus is also on inflation. Of course, in Spain, that wasn't as high as expected. That could make the job of the ECB a little bit easier. The focus also, of course, in the U.S. and the debt ceiling, and we know that Kevin McCarthy and Joe Biden are literally calling lawmakers on the phone one by one to get them behind their plan. The U.S. 10-year yield for the moment holding up 3.7346. Watch out for any sudden movements in T-bills like we saw in the last 3 weeks. You can see Brent 76.36. We had a good conversation, of course, in Qatar, also with the Saudi oil minister about some of the supply and demand going up there. Remember, June the 4th is a big deal for OPEC to meet. And then you can see the Turkish lira 20.2962. The focus on Turkish lira is, of course, some of the investors trying to read the tea leaves of what Erdogan does next, how he puts his cabinet together. And we understand, for people familiar with the situation, that they've also been trying to court the former finance minister, Mr. Şimşek, very well respected amongst economists and, of course, amongst G20 leaders. Now, there is a little bit of a difference between the DAX, that's gaining 0.3%, also gains for the FTSE MIB in Italy, and then the CAC 40 down 0.3%. Now, the White House and Republican leaders have geared up their lobbying campaigns as they look to win support for a deal to raise the debt ceiling and avert a default. Now, President Biden has been personally calling lawmakers to support the bill with a vote in the House, likely on Wednesday, before he goes to the Senate. Well, joining us now is John Bilton, head of global multi-asset strategy at JPMorgan Asset Management. John, great to speak to you. Thank you so much for coming on. You're like Ninja John, coming into the studio to really make us smarter on the debt ceiling. Will we have a deal, or will we? I don't know what the markets are thinking right now, actually, is my question.
Yeah, well, look, I think the markets have clearly sort of seen it as being, there's a little bit of near-term relief. The ex-date where, you know, all hell was due to break loose, that seems to have been averted so far. Clearly, there's a lot of politicking going on in the background, as is always the case with these things. But the agreement between the two leaders, the leader of Congress and Joe Biden, is of pivotal importance. So really, at this stage, I think the market is moving its focus away from the immediate risks and more thinking and digesting, OK, what does this mean for growth going forwards? Maybe takes a tenth or a couple of tenths out of GDP long run, but by and large, it avoids this great unknown, which we've all been concerned about. So
it's not the time to you know, play something with T-bills or something like that, or are there pockets of the market which you can hedge yourself in case we don't get it in time?
Well, I think you've got the mechanics of the money markets will do what they do. I mean, ultimately, there is more funding to be done, more T-bill issuance, between $600 and $1 trillion due to be issued before the end of the fiscal year in September. And, of course, there's concerns among some that could lead to a big liquidity crunch. Reality, it probably transfers from other mechanisms, things like reverse repo, etc. But it's definitely worth watching. And I think the market will continue to look at that like a hawk. But by and large, at the moment, I think we're going back now to thinking about the Fed, to thinking about earnings, the usual drivers of the economy.
John, I love all your research notes because they're straight to the point, and you basically put it beautifully. It's like some of the near-term risks obscure some of the medium-term potential for a lot of the stocks. What are the medium-term potential?
Well, you know, we've been going through a downgrade cycle now for the best part of a year in earnings. Earnings were estimated, excuse me, to be coming in for this year at about $250 per share. They're now looking like they're going to come in around 220, maybe flattish to last year, maybe even slightly down. But what we're seeing is an economy which continues to function beneath the surface, albeit a bit slower. And that doesn't necessarily spell disaster for stocks now that we've repriced them lower. Are they a bit expensive? Yes, they probably are. We'd all like to buy things a little bit cheaper, wouldn't we? But the reality is, now as we look at forward earnings, we've got to start to think about 2024, 2025. And yeah, as we look beyond the near-term risks, those earnings could be going through a process of bottoming.
Unless we get a credit crunch. And I know, again, you think some of there are contained risks in regional banks and also commercial real estate, which is, a bolder call than most that come on here. But when do we know whether the consumer holds up in the US and elsewhere?
Well, the consumer is sitting on around $1.5 trillion of excess savings left over from COVID. True, it's not spread evenly across all of the consumer base. But gradually, as that gets taken down, and we see this saving maybe getting it down to around $1 trillion, $1.1 trillion at the end of this year, it means that you've got a substitute for consumption coming in there, and it's a powerful block of money. You can't have it both ways. You can't take all of that down to zero and then assume that we don't get some kind of spending boom. Consumers today are comfortable to use their savings to support consumption because the job market is relatively stable as things stand.
And that holds?
And we think that holds. Okay. We think that holds.
So the implications of some of the asset allocation, do you do it regionally, or if you want to, for example, play China, you buy an industry that's very exposed to China, such as luxury?
Well, I think we've got a few things that we can play. Chinese stocks look extremely cheap at the moment. But, how much they are reflecting concerns about the region from a geopolitical standpoint, that's open to interpretation. But certainly it's the only region on the planet, based on our long-term capital market assumptions, which has a positive tailwind from margins. So there's a lot of good things there, but I think that you've got to be quite selective. It's a stock picker's market, even today.
And you like treasuries. So when you look at, and I really love your portfolio insights because they're like neat and well put together. You have basically a high conviction on US treasuries, but then if you look at some of the different currencies, so you like yen.
Yeah, we think that the yen, we're seeing it today with the Bank of Japan beginning to get twitchy as the yen has sold off. We feel that we will get movement in Japan. They're just running some way behind US and Europe. We're seeing inflation beginning to pick up there. Would the Japanese like to get off of zero interest rates? You betcha. So we do think that there's support for the yen further out.
All right. Thank you so much. John Bilton, Head of Global Multi-Asset Strategy at JPMorgan Asset Management, stays with us. We have that inflation figure actually from Spain that we need to really dig deeper and try and understand what that means for ECB going forward. Now, we also need to check on NVIDIA. We know that the chief executive of Chip, NVIDIA getting the kind of treatment usually reserved for celebrities and sports stars during a trip to Taiwan. And you can see NVIDIA getting some 2.3%. If you look at some of the AI and the frenzy that it's gotten to some of the stocks as a whole, NVIDIA certainly had a dizzying week. I think on Wednesday, forecast revenue for the current quarter, that was more than 50% beyond analyst estimates. So that's really signaling some kind of explosive demand for the chips powering artificial intelligence tools like ChatGPT. We'll have plenty more on NVIDIA. The company's valuation is closing in on $1 trillion, a market no chip maker has ever hit. Coming up, China turns down a U.S. invitation for a meeting of the country's defense chiefs. We'll tell you why and what it means for relations between Beijing and Washington. That's next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, China has declined a U.S. request for the two countries' defense chiefs to meet this week. That's after Beijing raised concerns over sanctions that Washington imposed on its top general back in 2018. Now, let's bring back Bloomberg's Rebecca Thune-Wilkins. Rebecca, thank you so much for joining us again. What exactly is Beijing saying with this messaging?
Absolutely. Well, I think it's pretty loud and clear that although Beijing is going to send its defense envoy to this really important security forum that's happening in Singapore over this weekend, it's not yet ready to play nice with the US, despite this sort of walk back in language that we've seen from Biden and others. So officially, they have rejected this request for a sit down between the US Defense Minister Lloyd Austin and the Chinese counterpart. Security remains one of these issues that seemingly some view as irreconcilable, but it's very, very closely watched, of course, in this context by other nations in Asia who are finding themselves sort of refracted and increasingly troubled when it comes to treading a line between China and the US.
So, Rebecca, meanwhile, China's rejecting claims from the U.S. that it's de-risking rather than decoupling. It's fine nuances, but it can really get people going.
Well, Francine, I think from Beijing's perspective, there is no nuance here, in fact, actually, that although Biden has walked back his language and is now talking in terms of, as you say, de-risking rather than the decoupling word, which has really frightened some European nations, that actually one state sort of media commentary saying de-risking is simply another way of disguising decoupling. And I think the important thing for China, at least from Beijing's perspective here, is really whether or not we see a tangible change in the behaviour. And despite those meetings on the commerce level between Raimondo and her Chinese counterpart, we still are yet to see any pullback in some of those economic sanctions that the US and its allies have levied. So until we see any real substantive change, I think this shift in rhetoric really isn't holding much water when it comes to Beijing and its policymakers so far.
Thank you so much, Rebecca Chung-Wilkins, there in Hong Kong for us. Now, a key gauge of Chinese stocks in Hong Kong has raced to earlier losses today after trading close to a bear market. Well, weak economic recovery and tensions with the U.S. have left traders with little reason to buy. Still with us, John Bilton, head of global multi-asset strategy at JPMorgan Asset Management. John, we talk about fragmentation, we talk about supply chains, again, being rewritten. We know that, for example, Apple's looking more towards India than China. What does that mean longer term about where you want to be invested in?
Well, I think we've got to look at the fragmentation of supply chains as being a sort of general phenomenon. We certainly have seen some big geopolitical events in recent years. You know, start with COVID. We saw some of the fragility in supply chains, the invasion of Ukraine. We've seen the stresses in the energy market. So clearly what's happening is governments are recognising we may have hit a near-term limit in things like goods, energy, raw commodities in terms of sort of broad globalisation. But make no mistake, services globalisation is still running very strongly. What does it mean at the margin? I think it means that we potentially are seeing perhaps a move away from the absolute efficiency of supply chains, moving from just in time to more just in case. And that, by definition, means that you end up making investments which may not be as productive as you'd normally hope when you're putting money to work for long-term investment.
So does a just-in-case look like, John, for John Bilton? Is there a part? Is it almost like a natural hedge, even if returns are lower?
Well, I think what we've got to recognise, it's actually it's a general economy-wide thing. I mean, you may be taking a small amount out in terms of your overall economic efficiency, maybe slightly more inflationary at the margin, slightly less growth. But also there are things that can be done, and Europe's done an amazing job really in terms of pivoting to think, well, if we are going to invest in renewable energy, if we have to think about a broader global supply chain, how do we invest for the long term and potentially create new productive assets, renewable grid, sustainable grid, etc. So it's not all bad news, because what may have done is also brought forward some thinking and some investment, which is much needed over the longer run.
But when you look at the sectors, so I don't know how you play, is China going through a downturn that means that you retrench in terms of investments that are linked to China, or do you expect policymakers to you know, put in more to support the economy?
Well, it's a tricky one if you look at it, because actually China's done really well so far this year. Coming out of COVID, it definitely had a COVID dividend, ex-COVID dividend, very strong growth in the first quarter, in the first few months out of that. It's now slowing down to a more pedestrian level. I think we've got a situation where the Chinese authorities are likely looking at the world more broadly and thinking we don't really fancy an inflationary spiral kicking off, so we don't want to overstimulate. We're growing at a level which is pedestrian but in line with the rest of the world. It's not a bad news story, but it's being painted at the moment, I think, as a glass half empty story because of some of these geopolitical tensions, which, to be clear, are quite well reflected in valuations as things stand.
So do you buy more into China, and do you go for, how do you play China?
Well, I think, again, it comes down to it being more selective. I think we can see with this constant drumbeat of tension that you're not just going to get folks going and saying, I want to buy China just as a block. I think they're beginning to treat it more as a developed style market, more OECD style, thinking, where are the Chinese authorities putting money to work? We've got an ageing consumer here. We've got a more services-led economy. Where do we need to invest in things like healthcare, financial services, rather than the old, you know, construction and export type of boom which has led China in the past?
John, we also had that inflation figure out of Spain actually slowing more than expected, nearing a two-year low. What does that mean for the ECB? They're also going through some of the framework, right, and how they want to play it, and that will come out from here, I think, until the end of the year.
Sure. Well, look, I mean, you know, a bit like the Fed, You know, we saw inflation begin to turn back end of last year, beginning of this. You know, we're now 6 months down the line, still talking about have we had the last hike. You know, the ECB are not going to take just one data point.
No.
It's a very welcome one, don't get me wrong, you know, lowest in 2 years for Spain, but there's still signs of strong services inflation, even if goods inflation is cooling down. And make no mistake, the ECB, while they are no longer on the at or a little bit below 2%, they've got a more symmetric target. They have a target nonetheless, and it's a good way down from here. More rate hikes to come, to my mind.
But so are markets mispricing how aggressive the ECB also wants to be to make sure that inflation is under control? And actually, is the most painful part of going back to that target between, you know, inflation at 5% to 2% or nearabouts?
Well, you've got to remember, we hear it from central bankers all the time. Policy operates with a long and variable lag. They will keep going until they feel comfortable the trajectory is right. They will speak more hawkishly. And I expect that, you know, we're going through a period at the moment where the euro is weakening a bit because of more hawkish pricing getting put in for the Fed. Get down a cent or two lower than here, the euro could be the way to play it, because if you look at the economy in Europe plus the policy outlook, it looks like euro should probably be stronger in the medium term.
John, thank you so much, as always, for joining us. John Bilton, there, Head of Global Multi-Asset Strategy at JPMorgan Asset Management. Now, coming up a little bit later, climate change and the financial debt trap. Why higher interest rates and extreme weather are actually pushing emerging markets deeper into debt. We'll have a full roundup of that extremely important story. That's coming up shortly, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, let's look at what NVIDIA has been doing pre-market. It's actually gaining some 3.1%. Again, NVIDIA's market capitalization soared $184 billion in a single day, and actually drove an AI rally around the world. That was in the last couple of weeks. The company's valuation now is closing in on $1 trillion, a market that no chip maker has ever hit. In fact, one analyst responded with a research note entitled Greatest Beat of All Time. Remember, it was last Wednesday that they forecast revenue for the current quarter more than 50% beyond analyst estimates. Now, let's get your other stocks on the move with Joe Easton. Joe, start with supermarkets. You're looking at UK supermarkets, and good morning again.
Absolutely, Fran. Good morning. So there's loads going on in the UK supermarket space today. Firstly, we had the data today from the British Retail Consortium showing retail prices up around 9% in Britain. That's the highest level since 2005. Meanwhile, the UK government were on TV yesterday saying that they might actually try and cap some prices for things like eggs and milk in the supermarkets. That could be a risk. And then finally, the third bit of news we had was Asda doing a deal for E&G's supermarket petrol stations, and this would encroach potentially on Sainsbury's territory. Sainsbury's shares down slightly, Tesco managing to stay high. They do obviously benefit from the higher food prices, but that is a bit of a mixed picture. Marks and Spencer giving up some of those massive gains that we saw following their earnings last week. That one slightly weaker. Elsewhere, I'm also looking at the staple goods space. We've had a couple of CFO changes announced. Nestlé, they are recruiting the LSE, London Stock Exchange, Anna Manns to be their new CFO. She announced she would be leaving the LSE last year. That stock is actually falling, though, because their CFO, he's been there around 8 years. He's pretty highly regarded, and this has come as a bit of a surprise that he is leaving. Unilever as well, announcing a new CFO. A bit of uncertainty at both those companies, I think, that is hitting them. Meanwhile, finally, just quickly, WPP, one of the companies benefiting from that NVIDIA push into AI. NVIDIA and WPP, the UK company, are teaming up on AI in advertising. They say this will cut costs in terms of producing adverts, finding customers to target. That's boosting WPP. The best performer on the FTSE 100 today is the advertising giant here in London.
All right, Joe, thank you so much. WPP, you can see gaining some 2%. We haven't even talked about KitKat. We'll get that, of course, in the next one made by Nestlé. Let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Drones had damaged several residential buildings in Moscow early this morning, in the latest sign the war in Ukraine may be spreading beyond the country's borders. The mayor of the Russian capital says no one was seriously injured in the attack, the biggest on Moscow since the start of the war last February. Now, Japanese Prime Minister Fumio Kishida says he will fire his son from his post as political secretary. This comes after a scandal over a party held at the PM's official residence in December last year. The Premier had already reprimanded his son, but a recent poll showed 3/4 thought his behaviour was indeed a problem. Global News, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Coming up, inflation in Spain has cooled more than expected this month. We dig deeper into the CPI print with the latest on the PM's call for early elections as well. That's next, and this is Bloomberg. Joe Biden and Kevin McCarthy step up lobbying efforts in Congress to win approval of their debt ceiling agreement. U.S. futures and treasuries mostly gain. Well, a key gauge of Chinese stocks is hovering close to a bear market as pessimism builds. Beijing rebuffs a U.S. request for their nation's defense chiefs to meet. Plus, the Spanish Prime Minister, Pedro Sanchez, calls early elections after his Socialist Party suffers a crushing defeat in regional ballots, while May inflation figures slow more than expected. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, back to our top story today in the White House, and Republican congressional leaders are trying to rally support for an agreement to raise the debt ceiling. The lobbying campaign has ramped up as the U.S. draws closer to a possible default. Well, let's bring in Bloomberg senior editor Bill Ferries. Bill, lots of lobbying behind the scenes. What's it actually going to take to get this deal over the line?
Well, I think President Biden and Speaker Kevin McCarthy are both working hard to ensure that even though they know they'll lose some members in this vote, they're not going to get 100% support. They want to make sure that there isn't a critical mass of opponents on either the Republican or the Democratic side. So far, most of the opposition we've heard from are people you kind of would have expected to oppose the deal, particularly some of the Republicans in the House who, in their political careers, have never voted to increase the debt ceiling. Some of those Republicans say that Speaker McCarthy didn't get enough for their side in the talks, but they were never expected or never counted in the calculations about who would support this. So I think Biden and McCarthy are both looking to just make sure there's no critical mass of opponents and that a vote can happen fairly swiftly this week.
So, Bill, what are the biggest stumbling blocks?
Well, I think I think on the Democratic side, there are some people who are very much opposed to the increased work requirements for government aid. I think on the Republican side, frankly, some members don't think the spending cuts go deep enough. You essentially have the U.S. government holding relatively flat on spending over the next 2 years. Republicans went into those debt talks arguing for a 10-year cap. So that was their starting position and probably not something they expected to get. But 2 years for some is just far too little.
All right, Bill, thanks so much. Bloomberg senior editor Bill Ferries there with the very latest on the debt ceiling. Now, Spanish inflation slowed more than expected in the year to May, nearing a 2-year low. The data supporting ECB doves who say the continent's historic price spike is actually fading and interest rate increases can soon end. Now, for more, let's get straight to Bloomberg's European correspondent, Marija Tadeo. So, Marija, what does the CPI print actually tell us and what the ECB could do?
Yes, Francine, and if you look at the Spanish numbers, which obviously they provide a preview of the many numbers that will be to come and obviously culminate with the big euro area CPI print, what it shows is that inflation is cooling, but it's also cooling significantly. Now, overall, when you look at the headline number and the core number, which again, the Spanish measure core inflation is slightly different, but the direction of travel is the same. There is downwards pressure on inflation. Now, overall, and you alluded to this before, if you are on the dovish side of the European Central Bank, a lot of this could prop up the argument that the massive part of the tightening cycle has already happened. We've now entered the final stage, maybe higher for longer, but nonetheless, the bulk of the work of monetary policy has been done, and now it's a waiting time. That is for the monetary policy. That is for the ECB decision that is due in about 2 weeks' time. There's also the national dynamics of this for the Spanish government. In theory, this should be good news. Inflation had been a big narrative in the country, but obviously with this new election that is now expected to take place on July 23rd, a lot of this is up for play. Will the economy be significantly enough to change things for the Prime Minister?
So what's the thinking behind calling this election in July? I know, Marija, you intimately understand, of course, the inner workings of Spanish politics. It seems like a big gamble after he lost some regional elections yesterday. And also the 23rd of July, we haven't really seen many elections in the middle of the summer.
Yes, and Francine, you know very well in multiple countries, especially in the south of Europe, when you get to August, you clock out. It's a summer holiday. So a lot of this means that if you're going on holiday where you have to prep a way to vote by mail, and if you were expected or wanted to take a holiday, maybe you're not going to do it on the weekend. But a lot of this could have serious implications on the turnout. A summer election is always a big gamble. But the Prime Minister has two things in mind. If you don't like what people are saying about you, if you don't like the political narrative around you, you often try to change it as a politician. That's what he's doing. He is ripping up the script, trying to insert new talking points in the conversation. He woke up yesterday to very bad media coverage, essentially suggesting that he was a loser, and not just the Socialist Party, but really the entire left-wing universe of Spanish politics. Unquestionably a victory for the Conservatives. He's trying to do damage control, but also really contain, and this is the key, the narrative that the country has already started a new election cycle, changing from left to right. It is a risky move, but he's taken big risks in the past, sometimes paid off, and he's hoping to repeat that again. Can it happen? Well, the issue is that they're running almost more than 500,000 votes behind the Conservatives.
All right, Marija, thanks so much, as always, for that great insight. Marija Tadeo there on the Spanish elections and that CPI print out of Spain. Coming up, what will be the biggest risk for stocks over the next 12 months? That's our latest MLive Pulse question. We'll speak to Tim Craighead. We'll bring you the results next. This is Bloomberg.
I think we're in a challenging period right now, an anticipatory period as to what's going to happen with the debt ceiling, what's going to happen with the Federal Reserve on June 13, 14, and then what happens with the potential for a recession. But longer term, I'm in definite agreement that we should be deploying our cash.
With equities in about near the top of a 7-month range, it's really difficult to see that now, before this being solved, being the proper time for a real, true, genuine breakout.
We don't expect a big bear market either in US stocks.
The market's not pricing in a recession, far from it. I think the market's pricing in normalization. If we actually do enter a recession, and in our view, it's going to be a recession, because of the bank lending standards, because of the lagged impact of rate hikes, as the consumer savings buffer runs out.
We do expect a recession to begin sometime in the second half. And for the equity market, that means down first, and then likely back up, essentially to here.
Well, Bloomberg guests there answering our MLive Pulse question, what is the biggest risk to stocks over the next 12 months? Now, let's discuss all of this with our senior European equity strategist from our Bloomberg intelligence team, Tim Craighead. Tim, thank you so much for joining us. So first of all, what did we find out? There's like, a short-term risk that is not necessarily longer-term kind of advice for stocks.
Yeah, I would agree with some of those folks that were just commenting. Our outlook into mid-year and into the second half is one of a mixed market volatility, sloppiness, if you will. At this point, valuation is not stretched. It's 12.6 times forward earnings, earnings are now coming through, if you look at 1Q earnings, much better than expected, far better actually on a comparable basis than what we saw in the States. But you also have to realize the second half earnings outlook is for very muted growth, if not even a decline in earnings before we see some acceleration in the next year. And there are an awful lot of externalities that can create volatility with stocks at this point close to record levels. So, you know, it's a funny thing in that, you know, there's a lot of worry. Stock's pretty elevated right now, and we think that that continues to cause a little give and take.
Tim, the other thing, we're all obsessed with AI, and we're all obsessed with NVIDIA. I mean, this is just an incredible story. So last Wednesday, they came out with a forecast, and I think it beat 50% beyond analyst estimates. I mean, this could be the greatest beat of all time, and it could get to $1 trillion in market cap.
Well, and not only was it a beat by that much, but it was a beat of a big number. So it's like the law of large numbers don't count, right? It's interesting thinking about tech and where it's going. The positive is it's clearly driving the U.S. market from a sector perspective. If you look at RRG as a function, the tech stuff is in the upper right, you know, quadrant, and it's big. We don't have the equivalent here. You know, technology is 6% of the European market. It's almost 30% of the U.S. market. However, you know, tech isn't always so great. The reason why there was an earnings recession in the U.S. for the second half of last year and into early this year is because of technology. Where here, we've had better than expected earnings coming through, driven by things like luxury goods. So, you know, our equivalent in Europe, LVMH, but, you know, clearly it's a wholly different business and driver.
Yeah, it certainly is. And so the dynamics, of course, are very, very different. Tim, talk to me a little bit about risk and rewards going forward. So where do you see the main pitfalls?
So there are definitely external issues that we've got to stay on top of. The U.S.-China tension, and, you know, a little of that might be European-China tension. It's a geopolitical factor that we hope doesn't go pear-shaped, but we've got to monitor. Fine. The U.S. political cycle is gonna accelerate over the course of the next 6 months. And I think discussions about energy transition and how supportive the U.S. is with that big package that's currently plowing through markets and expectations may be a topic of discussion. The biggest single European issue to me, I'm going to sound a little bit like a broken record, is margins. It sounds really basic, but operating margins in Europe right now are hovering at 15%, which is close to peak levels, only better in 2007. And margins tend to be cyclical, and yet we've plateaued for a year.
I mean, you talk about this big package in the U.S., which is the Inflation Reduction Act. Does that take greening, you know, the economy and technology away from Europe and put them in the U.S.?
Well, thankfully, there is the European equivalent program.
Smaller.
It's smaller, but it's still sizable. And even though there is that, you know, Make It in America sort of context of the U.S. program, there's certainly European companies that are benefiting from that spending as well. So hopefully it doesn't go away. Hopefully this continues to be a big secular stimulus that will play through the global economy.
Okay, brilliant. Thank you so much for joining us. Tim Craighead there from our Bloomberg intelligence team. Now let's also get straight to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Prices in UK stores are rising at a record pace as the cost of living crisis shows little indication of easing. According to the British Retail Consortium, shop price inflation accelerated to 9% in the year to May. Lower energy and commodity costs saw some slowing of price rises on staples, including butter, milk, fruit and also fish. Overall, food inflation remains above 15%. Now, Qantas says running an international airline will be at least twice as lucrative in the post-COVID era, thanks to new income from lengthy direct flights and deep cost cuts during the pandemic. At its first investor day in 4 years, the Australian carrier gave an update on its vast fleet overhaul and also turnaround plan. The forecast suggests there will be be no immediate let-up to soaring fares for international travellers. And Xiaomi is deepening local sourcing in India, where the Chinese smartphone company is seeking to regain lost market share. It's the first time an Indian supplier will make an audio product for the Beijing-based tech giant. The president of Xiaomi India called it a milestone for the firm and proof of its commitment to the country. China's Shenzhou 16 mission has blasted off from deep in the Gobi Desert, showcasing the Chinese space program's rapid progress. State media reported the rocket took off on Tuesday morning, sending 3 astronauts to the country's space station. The crewed mission, China's 11th, comes as Beijing seeks to narrow the gap in its space race with the US. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Leanne Gerrans, and this is Bloomberg. Francine.
Leanne, thank you so much. Now, Turkish President Recep Tayyip Erdogan is expected to name a new cabinet in the coming days, with investors, of course, watching for any signs that he's willing to move away from his unconventional economic policies. Now, the most significant appointment would be Mehmet Şimşek, a former Merrill Lynch strategist who also previously served as the Turkish finance minister. On the back of that, I think a lot of the focus is on what bank stocks could do, gaining some 9% on the Turkish stock exchange. Well, Selva Bahar Baziki from Bloomberg Economics is in Ankara, and she joins us. So what can you tell us about this potential cabinet pick and how comforting that would be for international investors, Selva?
Yeah, Mehmet Şimşek is a former finance minister. He served in top economy-related positions before as well, and is quite a market-friendly name. He reportedly met President Erdogan in person just days before the president is expected to announce a new cabinet. And that increases the possibility he may take active part in politics again. Now, in our view, appointing officials like Mehmet Şimşek, who can help restore market confidence, would just be the first step the president could take for a policy reset. Declaring a firm commitment to central bank independence would be the next. The central bank itself would need to start a credibility-building exercise, tightening its policy stance and unwinding its complex set of regulation and practices in favor of the lira, including stealth currency market interventions.
So, Selva, are there any signs that Erdogan is also willing to change his overall approach to the economy?
Well, the country has been following an unorthodox policy framework guided by the president's unconventional view that higher interest rates actually put up inflation rather than the conventional view then down. This approach has led to a surge in inflation, severely negative real interest rates, taken a painful toll on the lira, and contributed to a ballooning external financing gap. We see the buildup in these economic vulnerabilities definitely calling for a policy pivot. Turkey has local elections coming up in March next year, and this likely means that the pivot that we foresee coming will feature a policy tightening that will fall short of what the economy needs. This may be better for growth in the short term, but it definitely means a weaker lira, higher for longer inflation, and trimmed long-run prospects for the economy going forward.
Selva, thank you. When you look at some of the, the pitfalls, how soon does President Erdogan have the markets on his side? How long does it take for them to turn if there's no significant change in how he handles the economy?
We have expectations of a high summer tourism revenue coming up. That would alleviate some of the pressure off of the lira, which has been actually suffering and recently hit an all-time low. That follows 2 currency crises in the past 5 years. At the end of the summer, when that revenue stream is also starting to run down, and with high external debt payments coming up in the last 2 months of the year, we see October as the latest point for a rate hike, potentially.
Thank you so much for all of the insights, Selva Bahar Baziki there from Bloomberg Economics. Now, coming up, why many emerging markets are falling into a climate debt trap. We'll discuss the impact of extreme weather on countries already burdened by debt. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, from farmers to governments, many in emerging markets are falling into a climate debt trap as unpredictable weather coincides with the surge in borrowing costs. So far this year, cyclones have battered Southeast Africa. The Horn of Africa has been hit with the worst drought in 4 decades, and record temperatures are currently being experienced across Southeast Asia. Now, for more, let's speak to Bloomberg's senior Africa reporter, Anthony Squatsin, in Johannesburg. Anthony, thank you for coming on again. So how are rising rates disproportionately hitting the most vulnerable countries?
Well, the countries that are most affected by climate change tend to be the poorest countries. Those are countries in Southern Africa, across East Africa, Southeast Asia, and perhaps parts of Latin America. And they tend to be highly indebted at the same time. So when they've had to pay to deal with climate disasters or to strengthen their infrastructure to deal with future climate disasters, they've had to weigh that up against taking on more debt or paying off their existing debt. And often the climate concerns get relegated to the back seat. So it's a big problem.
So what's the likely end result here for these nations?
Well, if things don't change in terms of the global outlook on climate finance, it's very problematic. We're going to see countries not able to invest to buttress their infrastructure and against floods and droughts, and build irrigation infrastructure. And every time we have a natural disaster, it's going to get worse and worse for these countries, impoverishing them more and increasing their debt. So it's deeply problematic. There is a big push to boost the amount of climate finance available to countries like this for climate adaptation project, but that's going to need a big shift in terms of how that money is offered, whether it's grants, deeply concessional finance, because they can't really borrow on commercial terms. It's just too expensive for them.
So, Anthony, how do you see this going as we get into COP28? Or is there how likely are we going to get an agreement into the winter?
I'm not sure we'll get an agreement, but I think it's going to be a major theme. We're going to see a lot of the lobby groups from poorer countries push hard for this, supported by big organizations like the Global Centre on Adaptation. It's a big focus. I mean, there is money going into mitigation, which is building renewable energy plants, because you can get a revenue stream from it. But there's very little private sector investment in climate adaptation, and not really very much in terms of grants or concessional finance either. It's just a really neglected area.
All right. Thank you so much, Anthony Squatsin, there with the very latest, of course, on this important conversation. He is our senior Africa reporter in Johannesburg. Now, let's take a look at some of the things that markets are watching out for today. 10 a.m. UK time, we'll get a final reading of Euro area consumer confidence for May. 2 p.m., European Central Bank Governing Council member Robert Holtzmann will speak at a banking event. Then at 4:45 p.m., the ECB's François Villeroy de Gallo will deliver comments at the Paris FinTech Forum. And then there are some Fed speakers a little bit later. 6 p.m. UK time, Federal Reserve of Richmond President Thomas Barkin will speak on monetary policy at an online event. Now, the other story we're watching out for is, of course, NVIDIA. We're close to a $1 trillion market cap. For NVIDIA, you can see a 3.1% gain on the back of some encouraging news. I mean, I have to say, it's almost been a dizzying week for NVIDIA. It all began on Wednesday when their forecast revenue for the current quarter was more than 50% beyond analyst estimates. And that really signals some of this explosive demand that we're seeing for chips powering artificial intelligence tools like ChatGPT. Well, Bloomberg Surveillance Early Edition continues in the next hour.
This is Bloomberg Surveillance Early Edition with Anna Edwards and Kriti Gupta.
It's 10 a.m. in London, 5 a.m. in New York, 5 p.m. in Hong Kong. Our top stories today. Selling the deal, Joe Biden and Kevin McCarthy step up lobbying efforts in Congress to win approval of their debt ceiling agreement. U.S. futures and Treasury rise after the holiday weekend. Drones have damaged several buildings in Moscow. It's the biggest attack on the capital since Vladimir Putin ordered the invasion of Ukraine. And market woes. A key gauge of China's stocks inches towards a bear market as pessimism builds. Beijing rebuffs a U.S. request for their nation's defense chiefs to meet. Good morning. Welcome to Bloomberg Surveillance. This is the Early Edition. I'm Danny Berger in for Anna Edwards in London. She's taking a long weekend holiday. Kriti Gupta in New York. Just back for your long holiday weekend. Kriti, I hope you're feeling rested, refreshed, maybe even ready to solve a U.S. debt ceiling standoff.
high expectations for what happens on this side of the Atlantic, Danny, but nevertheless, rested indeed after 3 days. Danny, when you look at the markets, though, and perhaps not seeing the same amount of kind of optimism to the same extent. I mean, you're seeing it, but it's not necessarily coming off of just this debt ceiling story. You're seeing it a lot coming from the tech story, and that's really where the outperformance really shows up. 0.5% already in the pre-market. A big, big caveat to what we've seen in the last couple of weeks. The idea here simply that we've kind of been in this wait-and-see mode for the equity market, but now they are charging higher. How much, though, is this a function of the debt ceiling as opposed to this kind of let's hop on the AI craze story? It's a similar interesting dynamic you're seeing in the 2-year yield, because even though we do have that debt ceiling debate kind of potentially behind us, remember that vote at 3 p.m. today, the 2-year yield still inching lower. You are seeing a bid into the bond market. So there is that realm of caution there. And I wonder how much of the geopolitics plays into that. We're going to dive into the 2-year yield hovering at about 4.52. Remember, the yield story has really been driving, is that the right word? The FX story, that's really important. The Bloomberg Dollar Index unchanged at the moment. But remember, you are seeing a tug of war between the most commodity kind of focused currencies, the EM currencies, and your traditional euro, pound, etc. Gold as well. This is really interesting because, again, unchanged here. If we were seeing a little bit more relief or perhaps less relief, we would see a little bit more action in the precious metal right now, 1944 on gold. But I think a lot of this has to do with how Asia is really factoring into the story. And this is really important. You were seeing a major divergence between what you saw in Asian stocks overnight. This is really, really important because China, of course, has been dealing with a bear market or a potential bear market, getting really, really close and then pulling a win at the very last minute. You have the same story, although to the opposite side, with the Kospi index. This is, of course, the South Korean index where a good chunk of their stock market is made with semiconductors. This is really important, higher by 1% overnight. But remember, they are actually hitting a bull market. So even though you see perhaps dodging that kind of hit, the bear market in the Chinese market, South Korea really thriving and outperforming. You saw that overnight as well. The currency story is all that more important as we see the dollar not really going anywhere. The Japanese yen absolutely is. Slight weakness there, or excuse me, slight strength there, higher by about 0.2% on the Japanese yen. This comes after the BOJ did have a meeting between some of their policymakers. Look, nothing groundbreaking there, but perhaps something in terms of reconsidering the way policy should make it. But this is all in the backdrop of growth and inflation, and specifically Chinese growth, which of course is weighing on sentiment when you look at copper, Danny, down about 0.3%.
It's that same exact Chinese sentiment that's been weighing on France. The luxury story's just been so dominated. The French indices had been doing much better, but that has started to come in. Another day of that. CAC 40, that's underperforming. Looking at the European map, Kriti, it is just kind of a spotty day, I should say, because it's not like the U.S. where it's one market, everything is off. Yesterday, you had only a few regional benchmarks not trading. The U.K. was off for a holiday. Switzerland, Denmark, just to name a few. There were a few others in there, too. Overall, European stocks ended the day lower yesterday, so you do see the UK, for example, having to play catch-up with it. So that means even though there's some divergences, overall, just on the surface level, Europe Stock 600 is unchanged. The worst performing stock in the FTSE 100 today is Unilever. It is down 1.5%. I don't know what it is about today, but apparently this is the day if you're a CFO of a consumer brand, you announce that you're leaving. It happened at Unilever. It also happened at Nestle. So something's in the water, apparently, or in the baby powder or whatever those companies sell. Unilever's also going to be losing its CEO soon, too, so a lot of changes happening there. Euro, that's a little bit weaker versus the dollar. It was weaker more than what we're seeing at the moment. We had some Spanish CPI come in, inflation not as bad as expected. That brought a little bit of relief to the ever-climbing euro. Spain also has an election to deal with. An early election is being called by the prime minister, so a lot of politics to work through there. And nat gas, it's now moving higher. Just moments ago, about 30 minutes ago, this was lower. It was at a 2-year low. I mean, it's barely higher. It is still extremely low thanks to the fact that, I mean, it's not a good story, but the economy isn't doing as well in Europe, so that means less demand for nat gas and just a lot of renewable energy. So, Kriti, I mean, this is a big change. This number right here, 24, from when it was triple digits in the middle of the energy crisis in Europe.
Yeah, it absolutely is. A lot of doom and gloom out there, Danny, but when you look at futures and you look at sentiment around the world, perhaps a little bit more green on the screen. It's all coming down to one thing where perhaps everyone breathing a little bit of sigh of relief. President Biden and House Speaker Kevin McCarthy reached a debt deal this weekend to avert a historic U.S. default. Biden spoke after the agreement was made on Sunday.
The agreement prevents the worst possible crisis, a default for the first time in our nation's history. An economic recession retirement accounts devastated, millions of jobs lost. I strongly urge both chambers to pass that agreement. Let's keep moving forward on meeting our obligations and building the strongest economy in the history of the world.
Joining us now, wake up early, Zach Cohen of Bloomberg Government. Zach, walk us through the details of this debt deal. We know that defense, for example, was a major sticking point. What do we know about the kind of givings and takings of this deal?
Essentially, what it boils down to is that the White House and House Speaker McCarthy and their assigned negotiators have essentially agreed to keep spending flat over the next 2 years, which obviously in a market that has seen increased inflation, that essentially means real cuts to especially non-defense spending, although defense is being kept at around 3%. Again, that's sort of what we typically be seeing as inflation numbers. And so there's a couple of other factors that are included in there. There are some new work requirements, especially on food programs, known as SNAP here. That was something that Republicans really wanted to see included, as well as a codified end to the student loan payments pause that the Trump administration had put in at the onset of the COVID pandemic. So there's enough here that both sides can really come together and say, we really need to pass this bill, and now it's just a question of actually getting the votes to do so.
Yeah, do they have it? What are been some of the reactions of the key constituents here that will determine whether it passes or not?
The first vote really to watch really is at 3 p.m. Eastern time today. The House Rules Committee. This is a smaller panel that essentially sets the terms for floor debate in the U.S. House of Representatives. You've got two more fiscal conservatives, people like Ralph Norman and Chip Roy, who have essentially said they will not support this bill, whether they would actually vote to try to block it from coming out of the Rules Committee and essentially bar it from coming to the floor. That would be a really key vote. And then I think the swing vote there could be Thomas Massie, who's a third sort of more fiscally conservative Republican. And the three of them, along with every Democrat on the panel, could cause some problems for that bill coming to the floor. That being said, we don't know that that will be the case. And so if they can come to an agreement on that, then it should go to the floor and get bipartisan support from mostly Republicans as well as enough Democrats to get it across the finish line, with probably a couple of defections, both from the right wing, the more fiscal hawks of the House, as well as more progressive or environmentalist Democrats who are not happy with some of the provisions that have been added to this bill.
Talk to us a little bit about timing here, Zach. The idea here simply being that the X date for the Treasury, June 1st, June 5th, wherever it may be, for the market, someone was saying it was back on Friday. When you kind of factor in the time it takes to actually write the legislation, put it to a vote, what are the chances the Senate clears it in time?
Senate Majority Leader Chuck Schumer has already said that he's asking senators to, be aware and be prepared to potentially stay through the weekend on Friday and then through the weekend in order to vote on these bills. If the House does pass it on Wednesday, which is the plan at this moment, then it would go over to the Senate and where they could clear it on Thursday and send it to Biden's desk by then. But the Senate has the filibuster, which essentially allows a single senator to hold up any piece of legislation if they have concerns with. This is something that Senator Mike Lee has even threatened to do over the course of these negotiations. No word yet on whether he would actually use every tool at his disposal to do that. You've got others like Senator Rand Paul that could, throw a wrench into the system. That being said, time is running really short to get it through the Senate, which typically takes a couple of days of up to a week to get any bill across its to-do list.
Yeah, really can't afford for things to drag on. Zach, thank you so much for that update. Zach Cohen of Bloomberg Government. So now that a deal has been reached, yes, it still needs to get through Congress, but now traders are switching their worries to what that increase to the debt ceiling could mean for money markets, could mean to the Treasury general account. Joining us now is Bloomberg Global Finance correspondent Sonali Basak. Sonali, because we have this issue right now where the Treasury's coffers are so low. What does refilling it mean? Could that add pressure to the financial system?
Yeah, it certainly could, and that is the worry out there of concern, as you said, is the Treasury general account, which has dropped to the lowest level since 2017 here. And the idea here is that issuance could really bring it back up by hundreds of billions of dollars over the next couple of months alone. This is $1 trillion through the end of the third quarter. So it's a very sizable amount of issuance that's being expected into the market. Now, Danny, of concern here is not only the sheer scale of the issuance, it is also who might be buying. Because traditionally, money markets might have been taking on a lot of that, but there is that RRP facility at the Fed. And the question is, do they start to move money out of that into these Treasury offerings that we're going to see? Or who else would be the buyer? And what other kind of pressures would that put on the market? There's a concern that the banking system might take on some of this as well at a time where people people are already kind of starting to get concerned about liquidity, as well as the bank's activity to really flush the money with the economy at a time where we don't really know the path of rates moving forward.
So that's the T-bill story. That's the market read through. Let's talk about the geopolitics here. There's a lot of executives that are going to China this week. We have Elon Musk and Jamie Dimon. Talk to us about how big of a deal this is for Wall Street.
Yeah, it's really interesting. There's a great kind of teaser on the Bloomberg terminal right now talking you through all the details of this event from JPMorgan. Morgan Stanley has a separate event, but JPMorgan's event here, 2,600 bankers, 2 days in Shanghai, CEOs, executives, Pfizer, Baidu, Starbucks. So you have a very significant range of executives coming into China, and the first really large global bank presence, the American bank presence in China since the end of the zero COVID policy. There have been pretty reduced ambitions in China as the economy had been weak. Global banks are making significant job cuts, Kriti, but at the same time here, there is still a lot of question around the Chinese consumer, and not just for Chinese companies, as we've been mentioning, but for a lot of global companies that are doing business with JPMorgan in China as well.
Well, certainly a lot to digest when you look at geopolitics and the China question that's kind of creating this overhang in Wall Street, but also on the geopolitical front. Shonali Basak all over that story for us. We thank you as always. And of course, Bloomberg will have exclusive access to JPMorgan's annual Global China Summit in Shanghai. We're going to bring you interviews with JPMorgan executives, including Jamie Dimon, and more tomorrow. Coverage you do not want to miss. And of course, as we talk about China and the banking sector, let's talk about China and geopolitics for a moment. China has declined a U.S. request for the two countries' defense chiefs to meet this week. That's after Beijing raised concerns over sanctions that Washington had imposed on its top general back in 2018. Joining us now to discuss is Bloomberg's Rosalind Matheson. Roz, thank you as always for joining us. What exactly is Beijing saying with this messaging?
Well, there are a couple of things at play here. One is, in fact, that this minister is sanctioned by the US, which makes it really awkward for the Chinese to agree for him to sit down in Singapore with his US counterpart. They've been saying for years that can't happen until those sanctions are lifted. But more broadly, of course, the defense space, the military space, the security space is really the area of high tension between the US and China. And that's one area where China's very clear. At the moment, our militaries are coming into close proximity in Asia. The US government has basically accused China of supplying weapons to Russia that may end up in Ukraine. And that's one area really where they don't want to have any discussions right now. They don't want to have any meetings between senior officials. But more broadly, there is a bit of an effort to get other officials to be meeting, particularly on the economic front, their secretaries of state possibly as well, all leading up to a further conversation even at some point between the president. So there is this approach to try and put things in different compartments. Areas that are too difficult are still off limits, but can we get a line of dialogue opening? So this really doesn't preclude that broader effort to put a floor under ties.
Roz, while we have you, when it comes to the latest with Ukraine and Russia, Russia has said that it downed about 8 drones over Moscow, that were aimed at Moscow, rather. Well, what do we know about this?
Well, we know this is the latest attack on Moscow. Of course, there was the drone that fell on the Kremlin earlier in May, letting off that little firework. But of course, there have been skirmishes on the border between Russia and Ukraine for a couple of months. Attacks really that hit Moscow itself, they're kind of embarrassing for the Kremlin and for the administration of Vladimir Putin, because really what Ukraine is saying, and whether it's Ukraine doing it overtly, whether it's pro-Ukraine groups inside Russia doing it, whether it's anti-Putin groups doing it inside Russia, the message is the same. We're able to reach you right in the heart of Russia, and these attacks are really about sort of like sending that message. So it's quite embarrassing for Russia that this is happening.
Right, and as you say, not the first one either. Rosalind, thank you so much. That's Rosalind Matheson from our Bloomberg Geopolitics team. Coming up on the program, pessimism grows over Chinese stocks. We're just talking about the geopolitics, but it's also a sluggish economic recovery. We're going to have more on that. And we're going to be speaking to Marija Veitmane, senior multi-asset strategist at State Street, on her outlook with one hurdle, the debt ceiling, being passed. And we're going to have more on that, too, the debt ceiling, that is, with Thomas Gift of University College London. This is Bloomberg.
Well, there's a lot of questions simply about growth in the United States. The idea here of whether or not the consumer is slowing down. But what about the rest of the world? Now that you have kind of this AI craze baked into the market, now that you have a lot of the debt ceiling saga, perhaps in the rearview mirror, I don't want to jinx it, one of the big focuses moving forward is going to be the Asian story. And I don't just mean geopolitics or supply chains. I specifically mean growth coming out of China. Fears are already baked into the Asian market. For our radio audience, stick with me. We are looking at a chart here of the MSCI China Index, essentially the Chinese stock market that has been really under pressure for, I want to say, going back to, well, mid-June 2021. You're seeing a lot of pain there. And essentially the concern is just how much of the growth is slowing down. Even if China has traditionally put 5-6% growth, we're now looking at, say, 3%. Look, growth is growth, but it is still slowing down at a pretty scary rate. And that is putting a lot of fears into the heart of equity market investors when you looked at China. But at what point does that spill over into the rest of the world? Joining us now is Bloomberg Markets reporter Justina Lee. Justina, is the Chinese growth story something that's being missed by the broader European and American investor base?
Yeah, it's really been pretty surprising, like how quickly the China reopening story has really run out of momentum. I mean, if you look at Chinese numbers there, I mean, industrial profits, property investment, retail sales, all of those have already started, disappointing on the downside. And at the same time, we haven't really had much monetary easing that a lot of economists have been calling for. And so I think if you zoom out, beyond China, I think that typically is bad news for Europe, given that they do, depend a bit for Chinese growth, and the stocks tend to be a bit more cyclical.
This is the thing. If we do get past this whole debt ceiling stuff, how long can this relief rally last? Because if we go back to the fundamentals, I mean, this fundamental and example maybe aren't that great.
Yeah, exactly. And of course, the narrative then shifts to, the Fed trajectory. And people already are getting more convinced that we're going to have another rate hike coming. Of course, we have jobs numbers on Friday that will kind of shed a bit more light on that. And I mean, as you kind of discussed in the last hour, and then we have liquidity worries coming from, this debt ceiling relief. And so obviously today markets are going to enjoy it, but it does feel like there are a lot of concerns down the road.
Yeah, plenty of stuff to still keep us up at night, even with the debt ceiling gone. Justina, thank you so much as always. That's Justina Lee from our markets team. And of course, for more market analysis, MLive Go is where you want to head on your terminal. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Danny Berger in London. Now keeping up to date with news from around the world, here's the first word. More than 30 NATO soldiers have been injured, along with at least 50 locals in northern Kosovo, as Serb protesters clashed with police and then with NATO peacekeepers. The demonstrators were seeking to block newly elected ethnic Albanian mayors from reaching their offices. The worst flare-up in violence in years threatens an EU-brokered plan to normalize ties between Kosovo and Serbia. Turkish President Recep Erdogan is promising a team with, quote, international credibility to manage the nation's finances. A new cabinet is expected to be named this week after Turkey's longest-serving leader extended his rule by another 5 years. Bloomberg has learned the most significant potential appointment would be Mehmet Şimşek, a market-friendly former finance minister. The lira weakened toward a record low after Sunday's runoff vote. Spanish Prime Minister Pedro Sanchez has surprised adversaries by dissolving parliament and triggering a snap general election. The move came just hours after the prime minister learned the full extent of his party's losses in local elections over the weekend. His opponents will have less than 2 months to prepare and campaign for the July general election, which had been expected in December. Prices in UK stores are rising at a record pace as the cost of living crisis shows little indication of easing. According to the British Retail Consortium, shop price inflation accelerated to 9% in the year to May. Lower energy and commodity costs saw some slowing of price rises on staples, including butter, milk, fruit, and fish. Overall, food inflation remains above 15%. Danny, 15% inflation and counting over in the UK. Is there any country that matches that or beats that?
I don't know, but I don't think so. And it's gotten to the point where the prime minister said he wants to talk with supermarkets about limiting their prices in terms of things like bread, butter. That's kind of worrying if you need to do something like that, Kriti.
Yeah, it really is. And I think it speaks a lot to the idea that, look, the cost of living crisis that you're seeing in the UK it's pretty brutal, and it might be here for a while.
Indeed, higher rates isn't going to make us less hungry. All right, coming up, we're going to be speaking to Marija Veitmane, Senior Multi-Asset Strategist at State Street. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Selling the deal. Joe Biden and Kevin McCarthy step up lobbying efforts in Congress to win approval of their debt ceiling agreement. U.S. futures and treasuries rise after the holiday weekend. Drones have damaged several residential buildings in Moscow. It's the biggest attack on the capital since President Vladimir Putin ordered the invasion of Ukraine. And market woes, a key gauge of Chinese stocks, inches towards a bear market as pessimism builds. Beijing, meanwhile, rebuffs a U.S. request for their nation's defense chiefs to meet. I'm Kriti Gupta in New York with Danny Berger stepping in for Anna Edwards in London. Danny, a lot of doom and gloom out there, but when you look at the markets, green on the screen because thank God the debt ceiling the crisis there may actually be averted.
Yes, we got there, almost, pretty much. Yeah, we got there. And that's part of the reason we are seeing a reaction in Europe. Okay, sure. Why would European stocks react to something happening in the U.S.? But I mean, we always see this, right? It's just reinvigorating the animal spirits, allowing a little bit of risk on. So on a benchmark level, European stocks up 0.1%. Now that differs between which benchmark you look at. The FTSE 100 overall is down. Part of the reason is it was offline yesterday, so it needs to play catch up to a red session yesterday in Europe. But it's also being dragged down by Unilever. They announced that their CFO would be retiring. Their CEO is also going to be stepping down, so a big change at the top. By the way, Nestle today also announced their CFO is leaving. Any other CFOs want to leave? Call into the program. We're happy to announce it live on here since today seems to be the day to do that. Meanwhile, euro, it is slightly stronger against the dollar. It was weaker in reaction specifically to Spanish inflation coming in weaker than expected. Still, that's rebounding a little bit now. Also rebounding is nat gas. This did start the morning down, and it started the morning at the lowest level in 2 years. Even though it's higher now, it still is reacting from more renewable energy coming out of Germany. A worsening economic picture means less demand for things like natural gas. It's still moving lower. But hey, Kriti, we'll just notch it as another green thing on the screen in reaction to the debt ceiling being figured out.
Well, speaking to yet another green thing on the screen, let's bring it stateside here, Danny, because you're seeing the exact same thing here in the States. In fact, the idea of Buy America seems to be really in vogue when you look at futures and treasuries alike, especially on the front end of the curve. 451 on that 2-year yield, down already by a move of 5 basis points. So bond volatility is back, but perhaps in a good way, unwinding perhaps a little bit of the hedging that was really leading up to this moment. Of course, futures higher by 0.5%. Again, some conviction, some momentum earlier in the session. What's interesting, though, is that even though, like I said, this Buy America theme may be in the air, the dollar isn't necessarily catching it. And that speaks to, once again, the unwind that you're seeing. Again, if you don't need that defensive bid, do you really need the dollar? I feel like that's perhaps the theme that you're going to see there, down by about 0.1% on the Bloomberg Dollar Index. But again, the defensive kind of just seeping into the commodity space just a little bit. Gold at 1948 on that precious metal, eking just a little bit higher by about 0.3%. Danny, about 30 minutes ago, gold is virtually unchanged. So I wonder if something's going on in the commodity space that we haven't yet factored in.
Okay, well, certainly a lot to mull over there. Let's get into some of these market moves. Joining us now is Marija Veitmane, Senior Multi-Asset Strategist at State Street. Marija, just moments ago, we got this headline on the terminal. NVIDIA rising 4% in the pre-market, set for a $1 trillion market cap. It's down slightly from that, but I got to ask, just on an index level on this American equity market, is it possible to be bearish as long as the AI trend is bulldozing over every bear?
Yeah, that's a really good question. And indeed, that's how we kind of see U.S. market as tech is almost kind of a sim on its own and doing really, really well. If you look at equally weighted index, not great. If you're looking at kind of performance of like traditional measures like cyclicals versus defensive, not great. So yeah, I mean, great if you're in tech. We love tech. We see a lot of potential there. Everything else, quite skeptical.
Quite skeptical, but Marija, you say a recession is hard to avoid and the equity market is not ready for it. You're talking about some pessimism looking in these corners of the equity market. What else needs to sell off to get us ready for a recession?
I mean, the first thing is, I mean, when I say equity markets is not ready, I mean, the first thing I look at is analyst earnings expectations. And that's just really difficult for me to square this idea that we're going into recession, bond market is pricing recession, we're thinking, well, when Fed needs to stop hiking cycle, when they start cutting, what kind of probability of recession there, rising and all that. And at the same time, you have equity earnings estimates to trough in Q2 and start rising in the second half of the year. So those things are really inconsistent to me. And either of them proving wrong, either we're not top of the hiking cycle or we are not at the trough of earnings is really difficult for equities to stomach. So that's for me the downside.
Well, Marija, when you go and look at, say, the equity market specifically, how do you evaluate the entry point here? It feels like valuations have completely gone out the window, especially when you look at kind of this tech-driven rally. To see some sustainability in this risk-taking, do you feel like you're still looking for that breadth, or is this one of those kind of FOMO moments?
I mean, first of all, I would probably say that I would rather be in bonds than stocks. So stocks really not my favorite asset class. But if you have to be in stocks and you're a long-only investor and you're looking about kind of relative performance, which stocks are less likely to go down, I think what you need to look at is not valuations, is kind of sustainability of earnings, where companies are better able to protect their earnings in a downtrend. So where we expect, as I said, we expect recession. So we expect pressure on corporate earnings, and that's why I kind of brought up a consensus estimate where I think they're wrong, they need to be lower. And okay, within that, which companies are able to defend their margins a little bit better than others? So to us, it's staples, it's healthcare, and it's actually tech. So those types of companies we like. Regionally speaking, it's probably US over Europe. So that kind of types of trade we're thinking. So it's not absolute performance of stocks, it's relative performance, and it's more defensive.
When you look at that relative performance, though, how much of the defensive trade is ultimately a growth trade at the end of the day? I'm thinking of names like in healthcare, for example, in tech, where you are actually seeing this massive investment, both fiscally, but also from these corporations themselves. NVIDIA is just one example, but a lot of these incentives from governments around the world, isn't there kind of a fundamental money investment narrative to perhaps prop up some of these gains?
Yeah, no, couldn't agree more. Couldn't agree more. I think the cycle is turning. So we do need to find areas where money is still coming, whether it's fiscal, whether it's huge cash flow generation things that we've seen in tech sectors, or maybe kind of windfall profits that we've seen in the energy sector in last couple of years. So yes, where do we have money? And free cash flow generation, cash on the balance sheets, those are really important factors for stock selection.
Somewhere out there, Cliff Asness at AQR is crying over you saying that it's all about growth and the value trade isn't coming in, Marija. Okay, you like bonds.
I mean, you
know
me long enough. I mean, I love growth stocks. I've been in tech.
I know.
For years and years.
I love that. You're like, please don't pit me against my peers. I don't want that. Okay, let's go away from equities then. Let's go into bonds. You like bonds. Where on this curve are you positioning? If you were on the front end, you probably got killed as of late, considering we priced out those rate hikes. But where exactly do you like?
I mean, you have to go for safety. You have to go for safety. And I mean, the key conversation we kind of thinking is that where is that terminal rate? And so market has done kind of 180-degree from kind of turns. Is that first we started the year of okay, well, Fed is going to pivot, and then no, data is stronger. Then we had banking crisis, and then we kind of data is being strong, and we are kind of crawling back higher. And our view is that inflation still hasn't been conquered. We still think, oh yeah, it's slowing down, but not fast enough. And we're seeing that terminal rate probably needs to be higher. So we're beginning to see this repricing, and I mean another hike coming, and probably pause. We don't see any cuts this year.
Yeah. I mean, the market doing a swell job as of late to price those cuts out for 2023. Marija, I'm afraid we're going to have to end it there. Thanks so much for joining us. That's the growth-loving State Street's Marija Veitmane. All right, coming up, we're going to turn our gears to politics. Thomas Gift, UCL Centre on U.S. Politics Director, joins us next on all things debt ceiling. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, an interview with Lazard President Ray McGuire. That coming up at 10:30 a.m. New York. This is Bloomberg.
Everything I'm seeing come out of this negotiation is gives me a source of optimism and thankfulness that we're going to get past this.
I think the clown show is over. I think there is a 100% chance this passes next week, and we're done with this for the time being.
This deal is pretty good. Not great, it's not perfect, but no deal ever is. So I think Democrats should be very satisfied with it.
But I think it does. I think that global financial markets and economic watchers more broadly will be breathing a big sigh of relief.
Obviously, when the US share market reopens on Tuesday, there's going to be a bit of uncertainty about whether it passes through Congress. So that's going to hold the market back a little bit.
And I think that it's going to be a positive development, and it does ease some headwinds that were threatening that global recession.
Bloomberg guests expressing optimism about a deal on the U.S. debt limit. The agreement forged by President Joe Biden and House Speaker Kevin McCarthy heading into a crucial final stretch with less than a week to win congressional passage before a June 5th default deadline. Joining us now from Washington is Thomas Gift, director of the UCL Centre on U.S. politics. Thomas, thank you as always for joining us bright and early from Washington. We really appreciate it. Talk to us about the nitty-gritty of this deal, though. How much of a difference to the economy is it really going to make?
Well, I think a lot of this has been priced in already, but it's certainly good news. I do think that this bill will get over the finish line because it's a big opaque item of legislation, and that allows both sides to kind of sell the proposal as a win precisely because it's so complex. There's enough room here for both sides to claim victory. Democrats can say that they safeguarded the most significant social programs. That includes avoiding any major overhauls to Medicaid. Republicans can say they achieved a reasonable degree of deficit reduction. That includes making headway into areas like work requirements for food stamps. Fundamentally, this is a moderate bill, and I think that's a good thing. We hear that there's no middle in Washington anymore, but if this deal gets inked into law, it'll be because of the political center, and it's almost certainly going to come in spite of defections from both the far left and the far right. But it's good news. I mean, this is, as some of the previous segments were saying, not an optimal bill, but we can expect that from a big compromise like this.
And talk to us a little bit about specifically when it comes to the timing of this deal. Again, one of the big concerns here was that the X date was going to be as early as June 1st. Are we going to make it in time?
Well, I mean, that's been one of the big challenges, of course, because it's got to get through the House, it's got to get through the Senate, and then it has to be passed, of course, by the president. And there is some concern, particularly if this gets delayed any further, that it might bring us past the X date. Could even see a filibuster in the Senate, which I think would be worst case scenario. Still, I think the timing works, but it's going to be coming right up to the fiscal precipice.
Thomas, you mentioned that some people said this isn't an optimal bill. What makes it not an optimal bill in your opinion?
Well, I think we've seen, obviously, that the debt ceiling hasn't solved structural indebtedness, and that's a real problem. Washington is operating on short-term election cycles. Policymaking is myopic. These are really band-aids that don't address the root problem of fiscal sustainability. And if you think about the political incentives, it's entirely predictable. House members, they turn over their seats every 2 years. So there's really no incentive to take a long-run perspective. And for all the talk of polarization and all the posturing over the debt ceiling, that produces an underlying consensus, which is that the federal government is going to spend more than it takes in. And the biggest divisions are just over what money is going to be directed to and the rate of increases in the debt. And of course, these ballooning expenditures mean one of two things. They either mean deferred taxation onto the next generation or enormous cost on servicing the debt, which will eventually force the government to cut large social programs because of crowding out. If not now, then later. And that will have to include, some of these so-called third rail items like Social Security or Medicare. So I think for all those reasons, it's suboptimal. I mean, it's good news in the short term, but in the long run, all of these issues are still there. And we're going to do this all over again, probably in January of 2025.
Oh boy, I mean, it happens every couple of years, doesn't it? And each time we're like, how are we here again? How are we talking about the debt limit, the debt ceiling again? Is there any hope, Thomas? Give us some optimism that someday that the debt limit could be abolished.
Well, you know, when the debt ceiling in the U.S. originated in 1917, it was set so high that it was almost implausible that the federal government would reach it. But in recent years, it's been used ostensibly to stop the government from maxing out on spending. But I'm really not even sure that it makes sense in the current climate, because all it seems to be good at is creating political turmoil and eroding the economic reputation of the U.S. abroad. So nothing's actually being remedied. Because, you know, again, before we know it, it's going to be 2025. The debt ceiling is going to come up again, and we're just going to be looking at the exact same thing. Everyone is or should be relieved if Washington manages to stave off this crisis. But, you know, American government has enough drama as it is, I think, without injecting even more precarity into a system regarding whether America's full faith and credit is going to be compromised. If there's no, you know, political will for fiscal restraint, then there's no political will for fiscal restraint. But I think a recurrent debt ceiling showdown just makes the balance sheet look a little less uneven. And no one can look at this bill and say it really accomplishes responsible budgeting. So I know you were looking for some good news. I don't see it. Republicans, of course, still think that this is a useful tool to kind of cut spending, a suboptimal one, but a useful one. But I just don't see any kind of consensus for abolishing it altogether.
The irony being that the, I believe, Debt Ceiling Act is actually called the Fiscal Responsibility Act in practice. Thomas, a final question to you. In the absence, despite there not being consensus, but in the absence of that debt ceiling limit, what would be an effective way in the future, in the long term, to rein in that kind of spending?
Well, I just don't think you're going to get it, because all the incentives are to spend more and more and more. And that's why I think maybe, you know, for many legislatures, there's really no incentive to do anything but this. I think even it's the case that a lot of members of both parties kind of wanted this fight because, you know, they inhabit gerrymandered districts. They're playing to the fringes of their bases where ideological purity is prized over everything else. Republicans really revel in this chance, I think, to smear Democrats as profligate spenders with no sense of fiscal restraint. And threatening a default is really nothing if they can score political points with their constituents. And Democrats perceive this as kind of an opportunity to depict Republicans as reckless, kind of blow up the system extremist, which is also a message that they can exploit for their political advantage. So, of course, this whole debacle really makes Washington look even more dysfunctional. But, you know, absent real pressures from citizens, we're not going to see reductions in the deficit. And if you look at polling, I think more and more and more, we're seeing that Americans like these entitlement programs. They like big spending. You know, they'll say in the abstract that they want a balanced budget, but whenever you go down the line on, you know, item X, Y, and Z, ones that they actually receive, it's kind of, you know, don't cut my spending, cut someone else's. Well, if everybody has that sort of philosophy, then you're never going to get any kind of compromise. So that's why I wish I could offer you some optimism this morning, but I just don't see it.
Thomas, the worst thing is we're out of time, and we're going to have to end it there on a very dour note. But hey, it's realistic. So thank you for joining us, Thomas. Really appreciate it. Thomas Gift there of UCL. All right, coming up, maybe this is a good story. NVIDIA continued its rally towards a $1 trillion market cap. Bad news, though, someone who it's not a good story for, Cathie Wood, who missed out on it. She called the chipmaker, quote, priced ahead of the curve. We're going to have more on that next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Danny Berger in London. Almost forgot your name there for a second, filling in for Anna Edwards. Let's look at some of the stocks we're watching in the pre-market trading in the U.S. Because, look, there's a lot of green on the screen. And a lot of it, Danny, is coming from really just three major names. Microsoft at the top of that pack, higher by about 1.1%. Getting some approval on that very controversial acquisition of Activision Blizzard. Now they have South Korea and China on their side.
Let me first say that you're lucky we are good friends, Kriti, or else I never would have forgiven you for slipping up on my name. Second of all, I got to say, like, it just becomes more embarrassing for the UK, who, of course, did not let this deal go through. Now you have South Korea, you had Europe, too.
Yeah, I mean, I wonder to what extent if the UK will ever reverse that deal, if they start to feel this international pressure. That's certainly something you'd have to watch. And speaking of international pressure, let's go to our other stock here. Tesla shares also moving quite a bit in the pre-market. To the tune of 2.8% higher. We're looking at a share price of almost $200 on that stock. This comes after Elon Musk is actually expected to land in Beijing this week alongside the likes of Jamie Dimon, for example. This seems to be a big week for execs landing there. Remember, he's visiting his Shanghai factory, Danny, the first time in 3 years for that stock or for that CEO.
Yeah, I was going to say, I know Beijing is literally just such a gigantic city, but imagine just walking down the streets and running into Elon Musk and Jamie Dimon. What fun that would be.
They are some lucky folks over there. But as we, of course, talk about this Asia tour, the NVIDIA CEO also getting a part of it, Danny. NVIDIA actually set to become the first chip maker to achieve a $1 trillion market capitalization as its blowout revenue forecast underline the enormous growth potential from AI. Shares higher by about 3.7% in the pre-market. It has, however, prompted some skepticism from the likes of Cathie Wood. Last week on Bloomberg, Wood defended her firm's decision to bail on NVIDIA in January.
NVIDIA has become a check-the-box stock. That's why the valuation is where it is. But we are looking for those plays that have not only the vision from management team point of view and broad distribution, but also proprietary data and AI expertise.
Well, look, Danny, her take has gotten quite a bit of backlash on social media and with the investor community, but it is fair to say that Cathie Wood did actually hold on to NVIDIA till I believe about $330 a share back when it wasn't even a major tech player. Should she get a little bit of credit for that?
I mean, I don't know. Probably not if you miss out on the bulk of the rally. It's that thing we say about, bears, for example. Sure, you're right, but if you're wrong on timing, it means you're wrong. Shuli Ren has a really fantastic opinion piece out, Kriti, basically saying she can't spot the next bull market. All of a sudden, she now cares about valuations.
Yeah, and at the core of Shuli's argument was simply that the macro matters, despite what Cathie Wood says.
Yeah, absolutely. It does. It matters for this whole market. We learned that last year, learning it again this year. All right, well, that's it for Early Edition. Surveillance, the normal one, it's ahead. Julie Norman will be a guest, among many others. This is Bloomberg.